Arrow Sewing is a company that has both Arrow and Kangaroo brands under its name. This particular company is one of the largest producers of sewing machine furniture, so it was a huge surprise to learn that this company has been acquired by a private equity firm. Today we're going to explore what private equity means and also try to understand what that will mean for us as consumers. Welcome to my channel, and without further ado, let's get into it. This report comes from PR Newswire. It says, Will Square Capital expands quilting and crafting platform through acquisition of Arrow Sewing. Will Square Capital, a St. Louis-based private equity firm, announced that its portfolio company, Tech Holdings, has completed the acquisition of Arrow Companies, a category leader of branded workstations, storage solutions, and related accessories designed specifically for quilting and sewing enthusiasts. Terms of the transaction were not disclosed. So now let's skip down to the very bottom of this article. And it says, Will Square Capital is a St. Louis-based private equity firm focused on acquiring and growing lower middle market businesses in the Midwest and Southern United States, with an emphasis on business services, niche manufacturing, distribution, and technology companies. The firm is currently investing out of Will Square Capital Partners Fund. So a lot of this language sounds very foreign to me. So first we're going to figure out what a private equity firm is, and then try to figure out what exact companies are inside of their portfolio. A private company is one that is not publicly traded on the stock exchange. So a private equity company would work with these private companies. So now let's go and get the definition of equity. This definition of equity comes from Google, and I'm just going to read a small snippet. We can think of equity as a degree of residual ownership in a firm or asset after subtracting debts associated with that asset. So that means that this private company has come in and purchased partial or maybe majority ownership of the company. We don't know the exact amount because the article did not tell us that, and I haven't been able to find any information online to tell us what exact percentage of the company that they purchased. But I do know just from watching Shark Tank that once you give away 50% or more of your total equity in your company, you no longer have a majority share, which means that whoever has the majority can make the decisions for the company, meaning that you would no longer be able to make decisions for the company. So this is a major thing, especially when it comes to Arrow, because we don't know what direction the company's going to go in after this. So let's go and look at the Will Square company and see what types of businesses are inside of their portfolio, because that will give us a little bit of insight as to what kind of direction they might be trying to go. Will Square has a lot of investments in random companies. They have acoustical products, modular room partitions, portable room dividers, heating and air movement solutions. And then you get down here and you see they have 3 companies that are sewing and quilting related. The first one is the Tech Brands, which is an e-commerce based marketer of branded products to quilting and crafting enthusiasts and retailers. Then you have June Taylor, which really surprised me, and I found out that they acquired June Taylor last year in 2023, and they are a leading designer and marketer of innovative quilting, sewing, and crafting products. And then of course you have Arrow. And on down the list they have a lot of other companies that are also in the lineup, and one of them that really stood out to me was that they are also in the automotive industry with automotive and industrial paint and supply products. So it's just a lot of random behind stuff up in here, and I think that when you have a company that has shareholders that are from different backgrounds that aren't really into quilting and sewing, that the company can really take a nosedive because the owner of the company is not in tune with what the consumer actually wants and desires. However, if they are working on the logistics side of things, then they may be able to make some improvements, because I do know that anytime you're working with furniture, that furniture is heavy, and we did have the issue with the Panama Canal drying up, and I do have a video about that, and if you haven't already, please do go and check that video out. I'll try to leave a link to it down in the description box and also here on screen. But anyhow, when you're dealing with heavy furniture and things like that, you can have shipping problems, and shipping problems will affect those sorts of companies more. So I could understand why they would potentially reach out and look for private equity companies to come in and purchase shares of their company so that they could get the capital that they needed to continue. However, this is a big risk because we do not know what this private equity company is going to do when it comes to the company, or how much share of the company that they actually do have. Arrow might not be seeking private investors to help with logistical problems or shipping. They might be seeking private investors because they need help to execute a new plan or an innovative idea that they may have for their company in the future. And if this is the case, that is a good thing for us as consumers because we can see lots of new innovative designs out of this company. There's never been anything wrong with getting capital from different places in order to fund your business. Where the problem comes in is when you use a private equity firm, and it's because the private equity firm gains its money in order to buy its shares of your company in very, very strange ways. And there is a video here on YouTube from the Market Exit who explains this extremely well. I'm going to play a snippet from his video and come back in with my commentary. I will leave a link to his full video down in the description box below.
The private equity firm knocks on the door of wealthy investors with a lot of money. For example, sovereign wealth funds, pension funds, universities, etc. And then they convince these investors that the private equity firm can give better returns on their money than other investments, such as public stocks.
So private investors are interested in working with the private firm because they think that it will give them more money on their investments than if they were to work with a publicly traded company that's on the public stock exchange.
And to create better returns, the private equity firm takes the investors' money, then borrows even more money from a bank, and then uses all of this money to buy out a target company that the private equity firm believes hasn't achieved its full potential. And once the private equity firm has acquired the company, the magic starts. The private equity firm puts some of its magic PE sauce on the company, and voila, after 5 years or so, it will be able to sell the target company to a much higher price, making the investors, but most of all themselves, very rich.
There's a couple of problems with the way that the private equity firm is structured. One, they are interested in making money. They have no personal interest in sewing or embroidery. And it's also a problem that they don't have an interest in sewing or embroidery because it means that they have no idea what their target audience wants or needs out of the product. So this could be a huge issue. We're going to skip ahead a little bit and figure out what this special sauce is that the private equity firm plans on putting on Arrow.
Ingredient number 1, life-changing rewards. To add sweetness to the sauce, the private equity firm promises the company's management and themselves life-changing bonuses if they meet certain thresholds. This ensures that the bosses will work extremely hard to extract value from the target company.
We spoke about this a little bit earlier. Arrow may have seen a benefit in working with the private equity firm because they thought that could help them with logistics or perhaps help them with a new idea.
Ingredient number 2, back-breaking debt. To add some bitterness to the sauce, the private equity firm makes the target company responsible for all of the back-breaking bank debt.
The debt part of this is what's most concerning because it means that Arrow could potentially lose a ton of money and not be able to pay back the debt. And if that were to happen, then they would go under. And I oftentimes wonder if Joann's was also the victim of a private equity firm because of how they have gone downhill so quickly. But you know, they always say that the borrower is always a slave to the lender.
Ingredient number 3, full control. To provide texture to the sauce, the private equity firm takes control of the target company to impose super smart management techniques.
In my mind, when I hear super smart management techniques, I think that the private equity firm would want to make the furniture cheaper so that they could get more profit out of each sale. And that would be very bad for us as consumers because it means that we would be getting a less quality product. But what say you? Do you think that the acquisition of Arrow Companies by Will Square Capital is a great thing, or do you think that it's just the first nail in the coffin? Please let me know your thoughts down in the comment section below, as I would be very happy to hear from you. Thanks for watching. Please like, comment, and subscribe to receive more sewing related content. Peace.